And lastly, if you have non-qualified investments like a non-qualified brokerage account, there is a lot of flexibility as we've discussed in the past about these accounts. And most of the flexibility we're talking about in times of flourishing, right? Like our coffers are full and we have this money that we're putting aside in these non-qualified brokerage accounts and we can access it at any age. There's no limit to how much we can contribute. There's all these types of benefits. Well, in times of hardship, there's some flexibility to these accounts as well that you don't find with your qualified retirement accounts. One of those measures of flexibility is the fact that you can access that money without penalty, but it could be accessed in a way that causes taxation. We've covered long-term and short-term capital gains on this podcast. Short-term capital gains are when you sell an investment for a gain that you've held for less than a year. A long-term capital gain occurs when you sell an investment for a gain that you've held for less than a year and a day. Short-term capital gains are taxed at your ordinary income rate. So if the highest portion of your regular income is taxed at 24%, you're going to pay 24% on a short-term capital gain. A long-term capital gain in most cases, unless you are just earning a very small amount of money or a very, very large amount of money, most people in the middle are going to pay 15% in capital gains tax. But if you do have some built-in losses into your account, then you can be strategic in raising cash from your portfolio that not only doesn't lead to more taxation, it can actually reduce your taxes. This is one example of the flexibility of a non-qualified investment account. The other has to do with how that account can be collateralized or leveraged through something called a securities-backed line of credit. A securities-backed line of credit is very similar to a home equity line of credit, where just like with your home, they look at how much equity you have and they give you a line of credit where you can tap into some of that equity. The same is true with a securities-backed line of credit. If you have $100,000 in a non-qualified brokerage account, they might give you a securities-backed line of credit for $50,000. Now, if I have $100,000 in my account and a $50,000 line of credit against that money, let's say that I borrow $10,000 from that line of credit. I still have $100,000. They're not reducing it from my investment. They're using that investment as collateral. And when I take that $10,000, I'm taking $10,000 of my available $50,000 line of credit. I'm not taking $10,000 from my $100,000 in investments. There's all types of flexibility to the repayment of these securities-backed lines of credit. It's interest only in terms of the required payment, which means in this time of financial hardship, you don't have to owe an arm and a leg. You're only required to pay the interest. If you keep the money in that account and you have enough collateral, there is in most cases no end date as to when you have to repay the money that you borrowed. This would be an extreme scenario because it's going to cost you more over the long run to not pay it back. But conceptually, if you borrowed that $10,000 and kept enough money in your investment account, you could pay interest only on those funds forever. There's not going to be an end date where they require those funds to be repaid. So when you're trying to balance accessing the capital with how much it's going to add to your budget trying to repay what you borrowed, a securities-backed line of credit can in some cases be even more attractive than a home equity line of credit, which in most cases is going to need to be repaid within somewhere between 10 to 20 years. But either one of these options in extreme scenarios need to be evaluated. And even if you choose not to take advantage of it, all we're talking about in this podcast is about learning and understanding your burn rate. And if you're an entrepreneur, you're very familiar with the term burn rate. It essentially means you're looking at your available assets and your available income, and you're trying to determine just how long you can burn through that cash before you literally have to close up shop. And all I'm trying to do in this episode is to extend your burn rate as long as possible so that when you're in these hopefully temporary situations, you give yourself enough room to pivot, to get through it with as little burns on your body as possible. And when you get on the other side of it, being able to put the pieces back together because you did the best job in the moment of limiting the damage to your financial portfolio. Again, I hope that you take all of these with a grain of salt. I hope you compare them to your financial circumstance and figure out which option may or may not work for you. It is definitely not a blanket recommendation for you to do all of them or any of them without going through that process. But I hope that if you do find yourself in dire straits, that I said something today that is at least somewhat helpful.